There is something today that I want to share with you guys that has saved my portfolio. This is part of my strategy. So I have a full strategy, and this makes up the majority of it, that I implement that has really proven effective because we've had a hard year and we might be going into a recession. And because I've done this, it's really proven to keep me afloat and not down 40+% like a lot of portfolios I've seen. So what is this strategy that I put forth that has saved my portfolio? It's nothing sexy, it's nothing eye-catching. It is simply being diversified. Yes, diversification is what has saved my portfolio. Now you might think, well, I already know this, but do you really put attention and time to it? Because I think it's something that's underrepresented. It's not really talked about much. But I'm going to show you guys an intimate view of my portfolio. I'm going to show you my strategy related to diversification. And really, diversification to me is just providing some protection for your assets. It's helping to reduce those losses and really pump up those profits long term, because a lot of people, what they will do is they will think they can outperform the broader market with a few individual stock picks, but that's proven to be devastating. And you work hard for your money. The last thing you want to do is make permanent losses, because companies do go out of business or they do spend decades going down and down and down. So today, what I'm going to do is we're going to look in my portfolio, and I want to put a focus on the ETFs in my portfolio, because most of the time I talk about my non-ETF holdings. So I think it's time to put some attention to those, and we'll get through those quickly. And in the end, there'll be a nice summary of them. And I think that'll give you guys just a little bit more of an opportunity to see some different funds that you might have not have seen before, and ones that I don't really talk about that often. So diversification, the optimum amount of holdings that the professionals say to have is between 15 and 30. Now I have 17 stocks and 9 ETFs, so that's 26 holdings total, so I'm right in the middle there. Now if you go above that, it's not to say it's wrong, but there's a point where it's unmanageable, because it's a lot of work to keep up with all your different investments, the earnings, the future outlook. All that stuff takes a lot of work. And so if you have too many, A, it's a little unmanageable. Actually, it's very unmanageable. And B, it dilutes your profits, because if you have 100 stocks and one of those stocks goes up 10%, it's barely going to budge your portfolio. If you have, let's say, 15 stocks and one of your stocks really takes off, it's going to have a larger effect for you. And so that's the reason why. Now, you don't want to go below that 15 range, because then you're putting too much risk. If one stock goes down, it's kind of the opposite. It's going to bring your portfolio down pretty drastically compared to 30 stocks. So if you just have 10 versus 30, let's say, it makes a big difference when some of your companies go under or go down massively. And I have a few in my portfolio. And what I'm going to prove to you guys today is just how well my portfolio has done because of the diversification. So let's look at my portfolio. This is something I promise to do with every single video. You have a YouTuber here that wants to be transparent and honest all the time. And if you appreciate that, be sure to subscribe. This is real money. These are real holdings. So I think the first thing you'll notice is I have allocation between the different sectors of the market. That's a very common thing. So I have technology, financial, real estate, industrials, communication, discretionary, staples, healthcare, some materials, and the energy and utility sector. That is very common, and it's a very good strategy. I go a few more steps beyond that. Within the sectors, I like to diversify where I have my companies that are different from each other. So you have Meta, for example, in the technology sector, that's heavy on the social media. You have Cisco, which is heavy on the equipment and the hardware. You have Amazon, that is really that e-commerce side of things. And this is considered a discretionary stock, but I put it in technology because they have their big, huge cloud Amazon Web Services part of their business. That's what this company is to me, is technology. And Microsoft, which just has those Office suite products. What I'm saying here is these are a very good diversification of companies within the sector. So that's the second step. The third step I take is I sprinkle in ETFs in the sectors that I deem I am not as familiar or educated on, and where I just want to add some more level of safety and cushion. So if you look at, let's say, the real estate sector, you'll see on the very right FREL. That's a Fidelity Real Estate ETF, And what that does for me is that an ETF is like a basket of stocks, right? So this one could hold, let's say, 100 stocks, and if I buy one share, it's gonna allocate it out between all those 100 shares based on its own allocation in its own fund. And what this will do if we bump up to the financial sector is it will add some safety. So Bank of America's up 21%, Allies down 23%. Together, those are a loss. It's a net loss. If I were to take those out and let's say I only invested in FNCL, I'd be in the green right now in that sector. So it shows you that usually ETFs perform very well if you pick good ones, because you also have Kathy Woods with her innovation ETF has done horribly, but to me, a lot of people put all their eggs in that basket, and that stock is very heavily focused on more speculative plays and companies that have earnings in the far future. And so people just weren't really, I think, analyzing that one correctly. So I also have an international ETF to get international exposure, and then a dividend ETF, my favorite one, SCHD. So what I want to do real quick is go through each ETF that I have quickly. We'll summarize it at the end and then have a few closing remarks. But again, my strategy for diversification is in between all the sectors, and then diversifying within the sectors, and then adding some ETFs in the sectors I am not familiar or educated on, because that helps bring more protection and safety in those areas should some companies go down. And let's just point out, Tattooed Chef is down almost 92%, Meta's down 42%, Amazon's down 18%, but my portfolio as a whole is only down 5.61%. A lot of portfolios I've seen are down a massive 40+% because they've only invested in, let's say, 3 stocks. They think that those 3 were gonna just rocket up, and they've gone down. Because a lot of people got into the tech sector pretty heavily, and that's proven to be disastrous this year. And then you have the opposite effect where people have so many stocks, hundreds of stocks. I know people like that, and their portfolio barely budges when there are those green days. And so I think that's why that 15 to 30 stock or holding count is a good one to have. So let's go into each ETF quickly, and let's start with the energy ETF, FENI. This is a Fidelity ETF, and you'll see the top 10 below, and at the very top it says the top 10 make up 67.43% of this fund. So what that means is these top 10 stocks that you see at the bottom left make up a huge portion of this ETF. So this one might be considered a little more risky, especially because the top 2 holdings both are 16 and almost 22% respectively. Now on the top right, you'll see most of these companies are in North America, some in Europe, and a few in Latin America. And the market capitalization, this ETF mainly has companies in the large and giant cap area. So this is what we'll be looking closely, or quickly, shall I say, with each ETF. So this is the energy ETF I hold. And at the end, the summary is going to reveal the expense ratio and any dividends that these ETFs pay. And hint, hint, all of my ETFs pay dividends. The next one is a healthcare ETF, and it's FHLC. Now, the top 10 comprise of 47.97% of this fund. And I like the top 10 allocation, the weight that they put to each one, because unlike the last one, the top one's only 8% instead of, I think the last one was 20-some%. And you'll see the top 10 here, Johnson & Johnson, Pfizer, so on and so forth. Again, most of these companies are in North America, and they're heavily in the giant and large capitalization area. Next up is the industrials ETF that I really like, and that's FIDU, F-I-D-U. Now the top 10, this is a smaller part of this ETF. It only makes up 31.76, and you'll see the top 10 companies there down in the bottom left. Again, mainly in North America are these companies, and this one's more heavy on the large cap, but has some medium cap as well. Now let's move into materials. This isn't one that I only have this ETF, no individual stocks, because I'm not really familiar or educated on this sector, but the top 10 holdings make up 48.56% of this fund. And the first one makes up 13.81% of the top 10, so it's a little heavy on that one. But, you know, if you look into these companies, you might see that, yes, that one is of high quality. And what's nice about all these ETFs is they're all passively managed. So I don't have to manage them. Somebody else does based on the goals of these ETFs. So you always want to make sure to look at the background as well. Now, most of these companies are in North America and Europe, and this one mainly invests in medium cap stocks. The next one is a financial ETF, and I really do like this one. It's FNCL. we'll see the top 10 make up 40.85% of this fund, and the weight between the top 10 is very healthy, starting at the 8.46% in Berkshire Hathaway. Most of these companies are in North America, a few in Europe, Asia, and Latin America, and this mainly invests in the large and the giant capitalized companies. And this is one that I do want to add heavily to, just because I think financials are a little bit hard to measure, and so that's why I'd want to do that. Next up is another one I like, and it's the real estate ETF, FREL. Now the top 10 make up 42.2% of this fund, and you'll see it's a very good weighting. The first one starts at 8.25% and it gradually goes down from there. Now this one looks like it's mainly in North America and it's mainly in the medium cap stocks, but there's a few large cap stocks. And so this is one that I also want to add a decent amount to and bring up the allocation in my portfolio. The next one is a utility ETF, FUTY. Now this one is heavier on the top 10. It makes up 52.2%, and the top stock there is pretty heavy weighted with 14.2%. Then after that, it gradually goes down decently. And this one mainly is in North America. That's a common theme, and it's mainly in the medium capitalized stocks. And so this one, I think utilities is kind of that slow, dependable grower. So this one will always stay a lower allocation. Next up is my favorite ETF, SCHD. This is definitely popular among dividend investors, and we will see their dividend yield at the very end. It's very healthy. Its top 10 makes up a healthy 40.98%, but I think the allocation is extremely good, with the top company only taking up 4.65%. So I think it's lower risk, it's more protected, and it's mainly in North America with a few companies out of Europe, and mainly in the large and giant cap stocks. And this one, again, is my favorite. So this one right now, I think it's 8.11% of my portfolio allocation, and I definitely will keep adding to this. I want to get it above 10%. The last one is my international exposure, and that's VXUS. Now this one, the top 10, you'll notice something very different. It's only 8.59%. That's what the top 10 holdings make up of the whole fund. And it's very low percentages. So you see the top one only makes up 1.41% of this fund. And so this one, to me, it's maybe a little too safe because it has a lot of holdings, and I'm going to point that out in a little bit. But it definitely, will just give me that exposure to international stocks. And we'll see here, it's mainly going to be in Europe and Asia, but also has some in Latin America, the Middle East, and Africa. Now, there's probably some North America ones that have presence globally, so that's probably why there's North American companies. And for this one, like I said, I think it'll be a slow grower, just because if that top stock there really took off, it's really going to make minimal effect on this ETF. So now let's look at a summary. I won't go through these individually, but I'll just explain it. These are my 9 ETFs. And in that first column is the ticker symbol. The second column is the number of holdings that this fund has. So for example, the first one, Fenny, has 118 stocks comprised of this fund. You'll notice the very last one, VIXUS, has a staggering 8,016 companies. What my opinion there is that this one's just very diluted. It's not really going to be a high growth ETF, but it's just getting me that exposure at least, because I do want to be diversified, and it's doing that for me. Now the next column is the expense ratio. This is what this fund charges, and it takes it out of the net balance of the stock price. And so you'll see all of these are pretty low. All the Fidelity ones come in at that 0.084%. The SCHD is even lower at a 0.06, and VIXUS is just a little bit higher at 0.07, so all very low. A lot of ETFs can be as high as 0.4 or 0.6, and the actively managed ones can be over 1%. So these are all very low. And then the last column is the dividend yields. So you'll see some dividends are in the 1% range, 2% range, and then a few in the 3% range, including SCHD at 3.14%. So you are getting some dividends, which is great. Now, I will say this, if you invest in individual companies in these sectors, you're definitely going to find companies with a lot higher yields, especially like in the real estate sector. Most the real estate stocks are the REITs, shall I say, are above 5%. But you're having a trade-off here, right? You're going to lower yield, but probably more protection. So for now, I think this is a great way to diversify my portfolio further. And you feel free to snip this if you'd like to individually research these. But I also want to point out something. If we go back to my portfolio performance, we will see here I am down 5.61%. Now again, Amazon's down 18.87, Meta 42.85. If I went really heavy, let's say I only invested in 3 stocks, like people I know, and let's say you chose Amazon and Meta and 3M, you would be deeply in the red. But the way I diversified, it's really saved my portfolio. And the way I measure that is putting it up against the S&P 500. So if I bring this up, we'll see here, as of November 30th, for a 1-year rate of return, I am just barely trailing the S&P 500. I'm down 9.67% in my portfolio, and the S&P 500 is down 9.21. Now in September, I was actually beating the S&P 500, and in October, I fell below, and I kind of have stayed there. But this is really impressive because, again, the S&P 500 is hard to beat. A lot of portfolios I've seen out there have been very tragic, and it's very sad and a hard thing to see because this is hard-earned money. We all put in and invest and try to make long-term profits, but some people like to trade and make short-term profits, but it rarely works out. So this is proof to me that my strategy is working. And I think it's important that you look at your portfolio and deem if you are appropriately diversified, under or over diversified. Do you have ETFs, or are you all in individual companies? It's all about your risk tolerance, what you're comfortable with. But I think my portfolio is a testament towards these hard economic times and the stock market having a really bad year, that I'm holding up very well compared to a lot of other portfolios. Doesn't mean mine's the best. Of course, I have some losers in my portfolio, but if you net everything out, I'm doing pretty well. And I think when the economy does turn around, I'll rocket back up pretty quickly. And so with that said, I'd love to hear your opinions on this. Again, this isn't a sexy topic, but I think it's one that is very important to focus on because this is important. This is our money, right? We're choosing to invest it in these companies or these ETFs, and we want to make sure we're reducing our risk because I think that's one of the most important things to do. So I'd love to hear your opinion and your feedback. And with that said, I hope you guys have a great day. Be sure to subscribe, and we'll see you next time on Mark Arnold's Finance.